Tate and Lyle agreed to a $2.7 billion cash takeover from U.S. rival Ingredion on Monday, handing shareholders a 58.7% premium to the share price that existed before the offer period opened in May. The number that matters is not the premium, it is the price at which Tate and Lyle was trading before the bid surfaced. At roughly 550p a share less than a year ago, after a profit warning in October 2025, the stock had shed more than half its value over 5 years. Ingredion's offer of 595p in cash is not generous relative to history, it is rational relative to where London's market had placed the stock. The board of Tate & Lyle, advised by Goldman Sachs and Greenhill, unanimously recommended the deal after concluding the financial terms were fair. That framing conceals a harder question: fair relative to what? The company had just completed a $1.8 billion acquisition of CP Kelco in 2024, building scale in specialty food ingredients. Yet the combined business could not hold its valuation on the London Stock Exchange. Ingredion is acquiring not just a food ingredient business, but also the upside from CP Kelco's integration that London's institutional holders had already written down. The capital flow signal here is directional. Foreign strategic capital entered at a discount created by domestic institutional exit pressure following October's profit warning, while the sellers, UK-listed shareholders, including those who provided irrevocable undertakings covering 17.1% of issued shares, took the cash rather than wait for the integration thesis to recover. This is the same structure that has played out at Schroders, Beazley, and Intertek in 2026. London-listed equity trading at a discount to private or strategic value, with foreign capital absorbing the gap at a price domestic holders could not hold. Bloomberg estimated on Monday that Tate & Lyle's deal had kicked off a pipeline of London transactions potentially exceeding $15 billion in value. That figure matters because it converts a series of individual exits into a systemic signal, not a sector rotation within the FTSE, but a sustained compression of London's equity risk premium that makes the remaining FTSE 250 names the next pool of candidates. What the 58.7% premium does not answer is whether that discount will narrow for companies that remain listed, or whether each successive takeover deepens the structural case for the next one. The Tate & Lyle deal surfaced on the same morning that Brent crude hit $97.57 a barrel, a 4.84% single-session surge driven by Israeli strikes on military-linked petrochemical facilities in western and central Iran, and Iran's retaliatory missile launches targeting Israeli airbases. The FTSE 100 opened lower and ended up only 0.11%, while Germany's DAX fell 0.75% and France's CAC 40 dropped 0.32%, a reversal of the usual relative performance dynamic. The UK equity market's relative resilience was not optimism, it was a structural artifact of the FTSE 100's energy sector weighting, which benefits from oil price surges even when the macro backdrop deteriorates. The mechanism matters here. The same crude price spike at compressed European industrial equities partially offset FTSE energy sector losses through higher realization prices, creating an apparent market stability that masked the underlying cost pressure building across UK corporates outside the energy sector. Iran suspended civilian flights at several major airports, and the Houthi movement announced a complete ban on Israeli-linked maritime navigation in the Red Sea. The Strait of Hormuz, through which approximately 20% of global oil supply transits, entered pricing focus for the first time since the April ceasefire. For UK industrial and consumer-facing businesses, already carrying the weight of a domestic cost environment, an oil price sustained above $90 is a margin compression signal that has not yet fully entered forward earnings estimates. The capital that entered FTSE energy names on Monday was not rotating into UK equities as a vote of confidence. It was a commodity-driven flow that happened to overlap with a London listing. The distinction is critical because the same geopolitical risk that lifted energy shares also raised the discount rate applied to every FTSE growth name dependent on stable input costs and consumer spending. Brent at 97.57 with Hormuz risk still unresolved does not resolve in one session, and the OPEC Plus decision to add 188,000 barrels per day in July offers a supply-side offset only if Iranian production does not simultaneously contract. The next variable is whether the diplomatic channel that kept Trump and Netanyahu in contact on Monday produces a ceasefire signal before the July OPEC supply increase becomes irrelevant to the pricing equation.
Diageo's case runs counter to the Tate & Lyle narrative in one specific way. It is a FTSE 100 name that avoided a foreign takeover bid not because it is well valued, but because its discount is misunderstood. Jefferies released a 99-page analysis on Monday, arguing that Diageo has overweighted premium spirits in a period of household budget pressure, and that the recovery requires a deliberate move toward affordable products, Smirnoff, Captain Morgan, Johnnie Walker Red Label, that received less investment during the premiumization cycle. The target price was raised to £20 from £19, maintaining a buy rating. The positioning signal is not the target price revision, it is the scale and timing of the report. A 99-page framework document from a major sell-side house, published ahead of a strategy update scheduled for 6 August, signals that institutional holders are actively re-evaluating the frame under which Diageo shares have been held. The stock has been trading at a 28% discount to the broader consumer staples sector, against a historical average discount of approximately 2%. That gap represents a 26 percentage point re-rating from peers, not a modest underperformance, but a full decompression of the premiumization premium that Diageo accumulated over the prior decade. Jefferies estimated that only around 16% of Diageo's portfolio is directly exposed to the premiumization hangover, and noted that in more than a quarter of its portfolio, the company is actually less premium priced than the wider market, turning what was framed as a vulnerability into an underappreciated repricing opportunity. The flow dynamic here is a shift from sell-side institutions maintaining a neutral or underweight stance into early re-entry ahead of the August strategy update. Whether that pre-positioning holds depends on one variable: whether the 6 August presentation confirms the affordability pivot as a deliberate and quantified strategy rather than a reactive adjustment. If the framing on 6 August is defensive rather than structural, the 28% discount to consumer staples peers does not narrow, it deepens, because the narrative that justified holding the stock through the downturn would no longer be operative. Every day after the close, we publish a market wrap and key issue analysis. Subscribe to the channel.